Hello, everyone, and welcome to a special edition mortgage market update, breaking down the most recent Fed meeting on November 1st. I'm Mike Greenlay, and it's great to once again have Eric Hendrickson alongside. He's the president of Tradition Mortgage. And Eric, as you well know, every report is scrutinized very heavily, especially when the Fed meets. And with the latest meeting, what did the Fed do, and what are the implications to mortgage rates?
All right, thanks, Mike. Well, really, the Federal Reserve's job, their mandate is maximum employment and keeping inflation at a moderate level. Their target is 2%. So really, the primary tool they have to manage that is what we effectively call the Fed funds rate. It's the interest rate that everybody talks about. Not everybody knows exactly what it is, but it's really the interbank borrowing costs, basically depository cost exchange. So really, how much direct impact does that have out there in the marketplace? Not as much as you think, but it's really more the symbolic move of it. The Federal Reserve is kind of the great economist, as we call it, and if they're moving interest rates up, signaling that the economy's too hot, inflation's a problem, it kind of really moves the entire interest rate curve in that direction. So the Fed funds rate has been increased significantly over the past couple of years, in an effort to really slow down the economy. But really the challenge is now, have they gone far enough or too far? There's a definite lag effect out there as rates go up. So the market had predicted, turns out accurately, that the Federal Reserve was going to pause, as they call it, and not move that interest rate upwards. So that was pretty much all priced into the market, including mortgage rates. But really the biggest element is in the post-meeting commentary when the Fed Chair, Jerome Powell, kind of talks about where they see the economy status as of now and what do they anticipate in the future. So really the good news is he wasn't overly hawkish, or he didn't state that, hey, they really need to continue to bump up the Fed funds rate. He did acknowledge that there's been significant increase in credit cost out there, both at the commercial banking level and the consumer level with mortgage rates. He referenced, the 8% level for mortgages, and that it does create a lot of headwinds for the economy. He did also acknowledge that supply chains are improving and that productivity should bring down inflation as well. But of course, like we expect from him by now, he always tempers it with, well, we just don't know for sure, and we may have to go farther. We have to wait and see if there's more data to support one direction or the other. So kind of with that, it was a big week with data as well too, and kind of coming right prior to the meeting, the ADP private payroll report showed, a below estimate number of new jobs created. That's a little bit of a wiggly report each month, so not a ton of credence is put on it, but some ISM reports, a number of economic reports did show slowing, which, not that you want to root for negative reports in the economy, but when the economy is overheated, you do want it to moderate in the efforts of bringing down inflation.
And I think most people they continue to ask the question, quite simply, are we there yet? Because, you have it rise, then you have a pause. People want to see the pendulum swing, obviously, back the other way. So the question, I'm sure, on everyone's mind is, are we there yet?
Yes, it is. And I guess I'm a little bit of an optimist, but I do believe that we are there. I think we've kind of crested over the top of interest rates. We are actually down back below 8%, a decent amount, for the top tier loan programs and highest credit scores. We're closer to, 7.5 than we are to 8. So that's great news. But really, it's data driven. I think the Federal Reserve is saying it right, that it's just all going to be about the reports. So you have to have, it's not just going to be one report, it's multiple reports. But there are starting to be, several pretty compelling arguments that inflation is coming down and employment is coming down to the degree where it's going to put less wage pressure out there. So, but it's one thing to get to the top of the mountain and then start to come down, but how fast are we going to come down from here? So, the Fed has talked about keeping interest rates higher for longer. I think it's just kind of like a parent kind of warning the kids not to get too squirrely. I think they're just trying to temper people from being too exuberant and having, the projection for interest rates come down too fast, because perception is reality, and as long as the markets think the Fed is going to keep the Fed funds rate higher, it kind of keeps all bond rates higher, including mortgages, and again allows the economy to slowly cool. So that's, they're kind of walking this tightrope. But I do think that if we continue to see moderate numbers for employment and inflation, we're already on our way, albeit slowly, kind of on the downward path for mortgage rates.
And whenever people see numbers, they see percentages, they want to know how are those numbers or percentages affected. And it's never just one other number or one other situation. It typically is a combination, as you mentioned, of things, of factors that have implications on those numbers. So what would you tell people when they say, what are other factors that do affect mortgage rates?
Well, we've been talking about kind of the fundamental economic elements, which are inflation numbers and employment driving inflation. So those basically the greater the economic activity out there, the more pressure on inflation. But the other element that we have to talk about as it relates to home loan rates, the reason people are listening to this, they're most likely in the real estate or home lending business, or maybe a potential buyer, is just the overall bond market yield. So we've talked about it in the past a lot, but the vast majority of mortgages that are written are funded by Fannie Mae and Freddie Mac, and they get their capital by issuing bonds in the bond market. These are referred to as mortgage-backed securities, or MBS. So those MBS bonds, the lifeblood of lending, where we get the capital to make home loans for you and me, we get that by issuing those bonds in the bond market, and those MBSs compete with U.S. Treasury bonds, very specifically, and other high-grade corporate bonds. So the more bonds that are out there, the more supply chasing a relatively finite amount of buyers, you have to increase the yields to get people to be interested in buying. And when you increase the yield on a mortgage-backed security, working that backwards, that means that the mortgages inside of that bond have to be higher rates. So the mortgage rate that you and I take out is going to be higher. So the more and more supply there is, the bigger challenges there are. And it's the U.S. government, it's finally kind of out there front and center that our deficit spending, our national debt is massive. And as rates go up, the debt service coverage on it is very massive. So as long as there's just these deluge of treasury issuance out there, it's going to pressure mortgage rates higher. And that doesn't necessarily have anything to do with economic inflation. That really is fiscal policy with the government. So as the world moves a little bit away from using the U.S. dollar as its piggy bank, which they buy the treasury bonds, if they're moving away from that, again, that's just less buyers, so higher yields. That has nothing to do with inflation. That's just supply and demand. So really, the U.S. government, if we're going to enjoy, the lowest possible mortgage rates, we're going to have to get that deficit down in the future, and that's going to be a big challenge.
Which brings me to, obviously, the mortgage rates and the housing market. The housing market obviously is on the tip of everybody's tongue as well. And so what would you say is the state of the housing market right now? And more importantly, what are the challenges and the things to be aware of with the housing market also as it relates to mortgage rates and how things have gone, from very low rates to where we are right now and then hopefully back again?
Yeah, the biggest challenge in the housing market, it's no surprise to anybody, is just the very low level of existing home inventory, way below historic averages over time. And again, this was created through the artificial phenomena of the government purchasing mortgage-backed securities, buying down interest rates on mortgages during the pandemic for 2 years. And you can debate, okay, they should have let off the throttle much earlier than they did, but they did allow a tremendous amount of people there to refinance to kind of once in a lifetime type of low interest rates. But the side effect of that is you've thrown off the normal turnover cycle of existing homes. So people are just what we call the lock-in effect. They're just locked into these ultra low rates, and there's just they can't bring it to themselves to sell, and you can't blame them for that. So really what would change that, we call it, we look at a metric It's really the current mortgage offering, the new mortgage, if you're taking out a new mortgage, what that new mortgage rate is compared to the existing average home rate out there, on the existing homes. So that kind of new old spread is massive right now. You're talking 400 basis points, 4%. So you're basically doubling your money cost if you were going to go take out a new mortgage, right? And that's just too hard for people to fathom. So I mean, probably the median rate. There's differing opinions out there, but I think it's right now it's kind of north of 3.5, 375. Now the average rate's going to go up. All these the few houses that are transacting right now, the new mortgages that are being created are certainly in the higher range, and it'll pull that up. But really, we view it as kind of the strike point for the kind of the bid where we need to be for the new old spread. I think general consensus is within 200 basis points. So if we're looking at average existing mortgages of close to 4, then more in that just under 6% range is probably where you'd see a really steady stream. And again, being 400 basis points away, we're a long ways away from that. Now there are factors that will help that over time, where a lot of those really low rate mortgages are smaller balances and they're short amortizations, 10, 15 years. They're paying down to zero, so those people won't have mortgages. Over time, a lot of people have taken out ARM loans, certainly the larger mortgages. I think 7 to 10 years now, probably 5-year ARMs have been popular the last 12 months. So as people get to the midpoint of their ARM loans, I think, I'm not saying the panic button hits, but they're interested in moving out of those mortgages. So I think you'll see some turnover out of that. If somebody's got an ARM that's expired and they really want to move, that'll give them impetus. And life goes on. People, pass away. People that buy a house when they're young, they start families, they grow, they get promotions, start businesses. So I think, it just over time, I think that strike price for the new old spread can move up. If it's 200 basis points over the next 12 months, it might be, 12 to 24 months from now, it might be 250 to 300 basis points. That really continues to unlock the market. But, that new old spread's got to come down significantly from where it's at before we're really going to see any meaningful movement. And unfortunately, it's going to take some time. So there's no magic bullet, but we do, hopeful green shoots here with some nice progress the past couple weeks. I think the Fed meeting this week in their commentary definitely was supportive of the direction we want to go.
I'm sure people are happy to hear that, in your opinion, we might have reached the crest and are maybe peeking over the hill now. And but obviously, what you're saying is that this isn't there's no quick fix, really. This is something that people have to stay the course, be patient, make smart moves, and that's the reality of the market now. So. Any final comments on how all that plays out for people? Because people typically aren't really patient.
No, myself included in that. But, if you look at it through a broader lens, where we're at now with mortgage rates back in the 7s and trending slowly down, if you look over the last 30 plus years, I mean, that isn't so far off the median. So in the broader context, again, it's just tough coming off such low rates, but overall, I think the rates will be more palatable as we adjust our expectations, and it is patient, and there are opportunities out there. I think that as we move into what is traditionally a little bit slower buying season, I think that will provide opportunities for people that are willing to look. So life does go on, and will continue to get better. And, traditional mortgage is going to be here to serve your needs now and in the future.
Well, thank you so much for all your input. We will continue to keep track of things and bring it to you in the best way possible.